Hello, and welcome back, guys. Lots of companies reporting today. This is breaking news, pretty much. So we're starting off with Google, Alphabet, and I'm going to be moving to Amazon and other companies as well in later videos. But right now, as I'm examining Alphabet and I'm pretty much refreshing, this changes all the time. Like earlier, it was 6.5% down. Now it's 4. Maybe guidance is about to come out. As you'll see here, I have this article, basically from CNBC, which changes all the time, gets updated, like updating 1 minute ago, as you'll see right now. So let's take a look at exactly what happened here with Alphabet and why the stock is down. Now, as you'll see, Alphabet missed on both top and bottom lines. That is basically revenue and net income is what this means. And the company stock is down 6% at some point. Imagine this was like posted 1 minute ago, it was 6%, right now it's like 4%. So this changes a lot right now. And earnings per share, as you'll see, is 105 versus 118 that was expected. So this is quite lower than expected here in terms of net income per share. And revenue is 76.05 versus 76.53, also missing on revenue here. That's the top line. And as you'll see, YouTube advertising revenue, Google Cloud revenue, both going down here. Again, less than expected revenue, as you'll see, both of these. And traffic acquisition costs also going down a little bit. I'm assuming the company is getting some sort of like austerity measures, and they're not spending as much to acquire customers here. Now, you will see that the company said it would take a charge of between 1.9 billion and 2.3 billion, mostly in the first quarter of 2023, related to the layoffs of 12,000 employees that it announced in January. And it expects to incur costs of about 500 million related to reduced office space in Q1. Again, they are laying off a lot of employees. This has, some repercussions, understandably. And advertising revenue fell short, as we talked about, and the same thing with Google Cloud. Now, again, this kind of report could slightly change a little bit later because of potential guidance news. This has deep effects for companies, and so if this is too good or if this is too bad, it could significantly alter the valuation. This is kind of why I am like refreshing these kinds of companies when they're having earnings all the time, because things change significantly and abruptly. As you'll see here now, it's less red. It's getting to less red territory. Now this can change again. But I do want to take a look at the company's valuation just quickly, use our tool here and see what is happening with the company and whether this kind of price 103 may be an interesting entry point even here. Although we have talked about Google in the past, and I own Google and at a higher price. I think I bought it near 118, something of that sort. I'm not entirely sure, but I think it was something around that range, maybe a little bit more even. But what is going on with this company? Now, the PE ratio is currently at 21, as you'll see. The price to free cash flow also at 21. And it's been dropping. As you'll see, it's been dropping pretty much every quarter and every year, pretty much. Although their revenue, net income, all of these have been growing pretty nicely. Outstanding shares also going down. The company has been buying back shares, although they haven't really announced any buybacks yet. Now, again, this could change. The call is still happening, so things could be happening as we are talking, as I'm making this video. But if something substantial happens, I will definitely let you know in a new video. Now, the total liabilities to free cash flow, 1.61. The company doesn't have many liabilities compared to the free cash flow that they generate. And their margins are pretty great, and they haven't really gone down that much, frankly. Obviously, they have gone down a little bit. This happens with pretty much every company, but they are still solid, as you'll see. And the returns are pretty fine over here for the company as well. So it's a pretty solid company. We have talked about it, again, in multiple videos. Now, I'm going to take a little bit of a look at our stock evaluation tool, and as usual, I will let you know if something new comes up for Alphabet. Before I move on to our stock evaluation tool, I kind of want to quickly browse our news here because they could very, very quickly tell me if something new is happening, because these are updated live pretty much. Again, these are part of our tools, of our tool here. It's a very handy little module. And you'll see that, they're talking about the ad revenue, the things that we talked about, shares deep on slight top and bottom misses. So this is what we have so far. But again, as I'm refreshing this, more news will be added, and maybe something new happens. Maybe they announce something. So yeah, I'll be on the look for anything new that happens. So what's going on with the valuation? What about the stock evaluation here? Now, the revenue growth of the company, 23, 24, 41. And it has been going lower, obviously. Like you would expect the revenue to grow at a lower pace in the most recent quarters. Again, mainly because of what is happening with the overall economy. And this is why I will go fairly low, actually significantly lower than what the company has been doing. 8, 10, and 12, I think, is representative for the next 5 years. Maybe they will grow a little bit more, but I think 1 or 2 years could be substantial for, the growth of the company potentially going down a little bit, if not most companies right now in the stock market. And in terms of the net income margin, again, this has been going up and down quite significantly. Right now it was less than 30. I will go, let's just go 23, 25, 26 and 28 here. 25 and 28. And in terms of the free cash flow margin, I'm going to go something that is typical, again, something near what the company makes, 80, 90 and 100, and 13% for the annual return that I'm going to be asking for. And when I hit calculate, and what are we getting here? You will see that the low, for the very low estimates here, is sitting at about $70, the medium at 90, and the high at 122 over here, being our green, with very, very conservative estimates, that is. Again, you can go a little bit higher, and you will be solidly in the green, so with a revenue growth that is a little bit more like 10, 12, and 15, for example, and net income margins that are a little bit more what the company would potentially be achieving. Maybe something like this, for instance. This will definitely take you a little bit closer, if not in the green over here. This actually is going to be green when the market opens tomorrow, it looks like. So very interesting things about the company, but I have talked about it. It's always a good idea, I think, at least in my opinion, to buy solid companies, even if they are a little bit more expensive, because all the other metrics matter a lot as well, like the revenue that the company is generating, the fact that they don't have debt. As you'll see here, the debt to equity ratio is also very low liabilities, great net income margins, a household name. So all these things matter a lot when we are picking companies, and it's always better to pay a little bit more than not having a star company really in your portfolio. And this is why overpaying a little bit for such companies, again, it's really dependent on the company, but a company like Google, I would be happy with a P of 25 even potentially, because again, it makes sense based on the growth that they have and all the other fantastic metrics that they carry, is the thing. So again, as you'll see, this is going down. If I refresh, I'm pretty sure this will change again. This changes all the time again because we are currently sitting at pretty much a phone call. So if there's something new comes up, I will let you know. But I wanted to make this quick video and hopefully you did enjoy this one. Again, stay tuned. I'm making videos for Amazon. Apple is also out, I'm hearing. And it looks like it's a little bit of a bloodbath for the Nasdaq. So remember to subscribe and stay tuned, because next few minutes I'm going to be giving you another few videos actually, about these companies. We're going to be analyzing those. And please remember to leave a like as well. That helps a ton. And I'll see you soon. Bye-bye.